Listen carefully, because moments like this don't announce themselves twice. History doesn't knock politely, it kicks the door in. Today's title may sound dramatic, but drama is exactly how financial turning points arrive. It's over, I have proof. Those words are not meant to scare you, they are meant to wake you up. On January 2nd, emergency emails allegedly revealed that the Federal Reserve quietly opened a $24 billion credit line to 3 banks. Not debated, not voted on, not explained to the public. And when institutions move in silence, it's never for comfort, it's for survival. Here's the hook most people miss. Markets don't collapse when everyone knows there's a problem. They collapse when confidence breaks behind closed doors. Credit lines are not acts of generosity. They are defibrillators. They are used when the patient's heartbeat is fading. And if the system was strong, transparent, and stable, there would be no need for emergency emails, midnight decisions, or quiet liquidity injections. This is not theory. This is how every financial stress event in modern history begins, quietly, urgently, and denied until it can no longer be hidden. Let me be very clear and very professional. A central bank does not deploy billions overnight unless something has already cracked. Liquidity problems don't appear suddenly. They build under layers of accounting confidence, leverage, and optimistic narratives. When banks need immediate access to emergency credit, it signals fear, not at the retail level, but at the institutional core. And institutional fear always moves faster than public awareness. By the time headlines catch up, positioning is already done. This is where mindset matters. Weak minds panic. Strong minds prepare. Powerful minds observe patterns. In 2008, we were told everything was contained. In 2020, we were told it was temporary. Every time the same playbook: deny, inject, reassure, repeat. And every time, those who understood the signals didn't wait for permission to protect themselves. They acted early, calmly, strategically. This moment is not about predicting collapse. It's about recognizing stress. And stress always exposes truth. Ask yourself a hard question. If the system was functioning normally, why the emergency? If balance sheets were solid, why the rush? If risk was under control, why secrecy? Power doesn't lie in having insider emails. It lies in understanding what such emails imply. They imply fragility. They imply leverage limits. They imply that stability is being manufactured, not naturally maintained. And manufactured stability always has an expiration date. Now here's the motivational truth most people avoid. You don't need to fear this environment. You need to rise to it. Chaos transfers wealth, but only to those who stay disciplined while others stay distracted. This is the era where critical thinkers outperform emotional reactors, where people who study monetary signals, liquidity flows, and institutional behavior gain an edge, not by guessing, but by positioning. You are not powerless in moments like this. You are early. Emergency liquidity actions are never random, and they are never casual. When a central bank opens a multi-billion-dollar credit line on short notice, especially through emergency communication channels, it signals the presence of stress that normal market mechanisms can no longer absorb. In functioning financial systems, banks fund themselves through interbank lending, repo markets, and customer deposits without the need for extraordinary intervention. The moment those channels tighten, confidence, not capital, becomes the scarce asset. That is when central banks step in, not to reassure the public, but to prevent institutional paralysis from spreading across the system. The critical hook most observers overlook is this: liquidity problems do not appear at the surface first, they emerge in the plumbing of the system. Funding desks feel it before traders do, and traders feel it before headlines ever mention it. A sudden need for a large credit facility suggests that at least some institutions were unable to roll over short-term obligations at acceptable rates, or worse, were facing counterparty reluctance altogether. Markets function on trust, and when counterparties hesitate, liquidity evaporates faster than any balance sheet can adjust. This kind of intervention also reveals timing pressure. If conditions were manageable, support would be gradual, transparent, and pre-scheduled. Emergency action implies that delay carried unacceptable risk. That risk is rarely confined to a single institution. Banks are deeply interconnected through derivatives, payment systems, and wholesale funding markets. Stress in one balance sheet rapidly becomes stress in many, forcing policymakers to act decisively to stop contagion before it becomes visible. Another overlooked dimension is the scale relative to intent. A $24 billion facility is not symbolic, it is functional. It is sized to meet immediate funding gaps, not hypothetical stress scenarios. That sizing reflects real calculations made under urgency, based on internal data the public does not see. When central banks commit capital at that scale, they are responding to measurable strain, not speculative fear. What makes emergency liquidity especially significant is what it implies about confidence thresholds. Institutions do not request or receive such support lightly. Doing so acknowledges vulnerability, even if temporarily. The existence of the facility confirms that private liquidity was insufficient at the moment it was needed. That alone challenges the narrative of stability, regardless of official assurances. The final hook is this: emergency liquidity buys time, not certainty. It stabilizes the present while quietly admitting that normal conditions no longer apply. History shows that these moments are inflection points, where risks either resolve through structural adjustment or compound through delayed recognition. Understanding that distinction is what separates reactive observers from prepared decision makers. Credit lines extended during periods of financial stress are fundamentally defensive in nature, regardless of how they are framed publicly. They are not designed to encourage lending, fuel economic expansion, or improve profitability. Their sole purpose is to stop deterioration from accelerating. When a central bank provides emergency funding, it is responding to a breakdown in normal funding channels, where institutions are no longer able to rely on market-based liquidity without facing punitive costs or outright refusal. That distinction matters because growth-oriented policy is proactive, while defensive policy is reactive, and reactive policy only appears when conditions have already worsened. The key hook many fail to recognize is that emergency credit is a signal of constraint, not opportunity. Banks that access such facilities are not positioning for growth. They are protecting solvency by managing short-term survival. This often reflects pressure from deposit outflows, rising funding costs, or collateral stress as asset values fluctuate. In these environments, balance sheets become fragile not because assets instantly collapse, but because confidence in their liquidity weakens. Once liquidity is questioned, even high-quality assets lose their utility as funding tools. Another critical implication lies in behavior. Institutions drawing on defensive credit tend to reduce risk, not expand it. Lending standards tighten. Capital preservation becomes the priority, and internal risk committees shift from growth targets to exposure control. This contractionary response can ripple through the broader economy, as reduced credit availability affects businesses and consumers alike. The irony is that while emergency credit stabilizes banks, it simultaneously signals an environment where economic momentum is likely to slow. The scale and speed of such facilities also expose urgency. Defensive tools are deployed when waiting is no longer an option. If markets were functioning normally, institutions would source liquidity privately, even at higher costs. Turning to central bank credit means that private markets were either unwilling or unable to provide sufficient funding. That refusal is not emotional, it is analytical. It reflects rising counterparty risk assessments, heightened uncertainty, and fear of asymmetric information. Perhaps the most important hook is this: defensive interventions change incentives. When survival becomes the focus, long-term strategy takes a back seat. Asset sales increase, leverage is reduced, and hedging activity intensifies. These behaviors can amplify volatility across asset classes, especially when multiple institutions act simultaneously. Emergency credit may prevent immediate failure, but it also confirms that the system has entered a phase where caution dominates confidence. Understanding emergency credit as a defensive maneuver reframes the narrative entirely. It is not evidence of strength. It is evidence of strain being managed in real time. And in financial systems, strain that requires management has already crossed a critical threshold. Opacity during periods of financial stress is often justified as a tool for stability, yet history repeatedly shows that limited disclosure carries its own risks. When emergency actions are communicated quietly or revealed indirectly, markets are left to infer intent rather than assess facts. That gap between action and explanation becomes fertile ground for speculation, and speculation is far more destabilizing than transparent data. Confidence in financial systems is not built on perfection, but on credibility, and credibility weakens when decisions appear rushed, concealed, or selectively shared. The first hook to recognize is that markets react more violently to uncertainty than to bad news. Investors can price losses, they cannot price unknowns. Emergency measures communicated through unofficial or constrained channels signal that authorities are managing perception as much as policy. While this may contain short-term volatility, it increases long-term fragility. Once participants suspect that not all information is being shared, risk premiums rise across the board, affecting equities, credit spreads, and funding markets simultaneously. Opacity also distorts price discovery. Financial markets function efficiently when participants have access to consistent, timely information. When key policy actions occur without clear explanation, asset prices adjust unevenly, favoring those closest to institutional signals. This creates a two-speed market where informed players reposition early, while the broader market reacts later and more aggressively. That imbalance undermines trust not only in institutions, but in the fairness of the market itself. Another overlooked hook is how secrecy alters behavior inside financial institutions. Risk managers, treasurers, and counterparties respond not just to official statements, but to what is left unsaid. Silence from policymakers during emergency actions is often interpreted as unresolved risk. In response, institutions increase liquidity buffers, reduce exposure, and demand higher compensation for lending. These defensive shifts tighten financial conditions even when policy is intended to loosen them. The reputational cost of opacity also compounds over time. Once emergency actions are eventually disclosed, the focus shifts from the necessity of the intervention to the delay in communication. Markets begin to question what else may have been withheld. This retrospective skepticism can reignite volatility long after the original stress has passed, prolonging instability rather than resolving it. The most powerful hook is this: transparency is not a threat to stability, it is a prerequisite for it. Attempts to control narrative through limited disclosure often backfire, transforming manageable stress into systemic mistrust. In modern financial systems, where information moves instantly and globally, opacity does not prevent panic, it postpones it, and postponed panic tends to arrive with greater force. Liquidity stress is almost always the first visible fracture in a financial system, long before solvency is openly questioned. Institutions rarely fail because assets instantly lose all value. They fail because those assets cannot be converted into cash quickly enough to meet obligations. That distinction is critical, and it is the first hook many overlook. A bank can appear solvent on paper, while being effectively insolvent in practice if liquidity dries up. When funding markets hesitate, time becomes the enemy, and liquidity becomes more valuable than capital itself. The early stages of stress are subtle. Funding costs creep higher, collateral haircuts widen, and counterparties become selective. These signals do not make headlines, but they reshape behavior behind the scenes. Institutions begin hoarding cash, shortening maturities, and avoiding exposure that even weeks earlier would have been routine. This is where liquidity crises are born, not in panic, but in caution. And caution, when synchronized across institutions, tightens conditions rapidly. The second hook is historical consistency. Every major financial crisis follows this sequence. Liquidity support arrives first, framed as temporary and precautionary. Solvency concerns emerge later, once asset values are reassessed under stress conditions. Emergency funding can stabilize flows, but it cannot repair balance sheets if underlying assets are impaired or over-leveraged. It buys time, not resolution, and time only helps if structural weaknesses are addressed during that window. Liquidity facilities also mask deeper problems. By providing short-term funding, policymakers prevent forced asset sales that would otherwise reveal true market pricing. While this avoids immediate collapse, it delays price discovery. Assets remain on balance sheets at optimistic valuations, and risk remains misallocated. The longer this persists, the sharper the adjustment when confidence finally breaks. This is why liquidity interventions often precede rather than prevent solvency debates. Another critical hook is psychological. Liquidity stress changes perception faster than fundamentals change reality. Once institutions suspect that access to funding is uncertain, behavior shifts defensively regardless of official assurances. Credit lines are drawn, leverage is reduced, and lending slows. These reactions can turn a contained liquidity issue into a broader economic slowdown, increasing the probability that solvency problems eventually materialize. The most important insight is this: solvency crises are rarely sudden, they are revealed. Liquidity stress pulls the curtain back, forcing assets and liabilities to be tested under real conditions rather than theoretical models. Emergency funding can delay that test, but it cannot cancel it. Understanding liquidity as the early warning, not the solution, is what separates surface-level reassurance from serious risk assessment. Institutional positioning always shifts before public narratives change. and that timing gap is one of the most powerful yet least discussed forces in financial markets. Large banks, hedge funds, and asset managers do not wait for press releases or televised explanations. They react to signals, subtle changes in funding conditions, policy behavior, and counterparty tone. When central bank actions occur quietly or urgently, institutional desks interpret them immediately, adjusting exposure long before broader market participants recognize a shift. This is the first hook. By the time information feels confirmed, positioning has already happened. These institutions operate with real-time access to market plumbing. Repo rates, collateral availability, bid-ask spreads, and settlement flows provide early warnings that never appear in headlines. When those indicators tighten, capital moves defensively. Risk is reduced, leverage is trimmed, and liquidity is prioritized. None of this requires public panic. It happens methodically, often invisibly. Retail investors, relying on delayed disclosures and simplified narratives, remain positioned for normal conditions while institutions quietly prepare for abnormal ones. The second hook lies in speed. Institutional capital moves faster not because it is smarter, but because it is structured to respond immediately. Mandates allow rapid reallocation, and risk models update continuously. When a policy signal suggests elevated stress, portfolios are adjusted within hours, not weeks. This creates an asymmetry where markets appear stable on the surface, yet underlying liquidity thins as informed participants step back. When the repricing finally occurs, it feels sudden, but in reality it has been building beneath the surface. Another critical dimension is signaling behavior. Institutions do not need explicit confirmation to act. They infer intent from scale, timing, and urgency of policy measures. An emergency facility, even if framed as precautionary, sends a message that normal assumptions may no longer hold. That message is received instantly by those trained to read it. The public, however, is often reassured by official language, widening the perception gap further. This timing imbalance amplifies volatility once awareness spreads. As delayed participants react, prices adjust rapidly to reflect conditions institutions have already discounted. This is why market moves often feel disproportionate to the news itself. The news is not the catalyst, it is the confirmation. The real adjustment began earlier, quietly, when positioning shifted out of view. The final hook is this: markets do not reward information equally, they reward timing. Institutional positioning ahead of public awareness is not unfair, it is structural. Understanding that structure changes how risk is managed. Those who wait for clarity inherit volatility, while those who recognize early signals navigate transitions with far greater control. Policy intervention during periods of stress reshapes how risk is perceived, priced, and ultimately mispriced across financial markets. When emergency credit is introduced, it interrupts the natural feedback mechanism through which markets assess danger. Under normal conditions, rising risk is reflected through widening spreads, falling asset prices, and higher funding costs. Emergency support dampens these signals, creating an artificial sense of stability. This is the first hook. When risk signals are muted, risk does not disappear, it accumulates quietly. By suppressing short-term stress, policy intervention alters investor behavior. Market participants begin to rely less on fundamentals and more on expectations of continued support. This dependency shifts pricing away from intrinsic value and toward policy assumptions. Assets that would normally reprice lower remain elevated, encouraging leverage and complacency. Over time, this widens the gap between perceived safety and actual exposure, making the system more sensitive to future shocks. Another powerful hook is the distortion of incentives. Emergency credit reduces immediate consequences for excessive risk taking, reinforcing the belief that downside will be managed externally. This does not necessarily reflect reckless behavior, but rational adaptation to the policy environment. When participants expect intervention, they adjust strategies accordingly. The result is compressed volatility in the short term and amplified volatility later, once support is questioned or withdrawn. Risk pricing is also affected across asset classes simultaneously. Equities may stabilize, credit spreads may narrow, and funding markets may appear calm, but these moves often reflect liquidity conditions rather than improved fundamentals. This creates cross-market correlations that increase systemic vulnerability. When the next stress event emerges, assets that were previously considered diversifiers begin to move together, intensifying market dislocation. The temporal effect of intervention is equally important. Short-term calm can delay necessary repricing, allowing imbalances to grow. When adjustment eventually occurs, It tends to be sharper and more disorderly because it reflects accumulated mispricing rather than incremental correction. This pattern has repeated across cycles where periods of policy-induced stability precede abrupt market resets. The most compelling hook is this: emergency intervention does not eliminate risk. It relocates it in time. By pulling volatility forward from the present into the future, policy actions trade immediate stability for long-term fragility. Markets appear calmer, but only because risk has been deferred, not resolved. Understanding this dynamic is essential for navigating environments shaped less by fundamentals and more by policy-driven distortions. So let me close with this: it's not over because the world is ending, it's over because the illusion is cracking. The illusion that everything is fine. The illusion that systems run on honesty instead of confidence. The illusion that warnings come with sirens. They don't. They come as quiet emails, emergency credit lines, and reassurances that arrive a little too fast. This is your moment to think sharper, move smarter, and stop outsourcing awareness. Don't wait for headlines to tell you what institutions already know. Strength isn't reacting last, it's preparing first. Stay alert, stay educated, stay disciplined. Because when the dust settles, history will not remember who panicked, it will remember who understood the signal before the noise.